Welcome to Comedy 360. This is Zahid Awan, your host, with new real estate updates. And today we will talk about real estate investment. A lot of people appreciated what I'm doing, giving them information about real estate, but they asked me to educate them about the real estate. Is it right time to invest? Where to invest? How to invest? How much to invest? What are the risks? And what are the pros and cons? So I will go through in detail, but I should tell you that I am not an attorney, I'm not a advisor, but I've been working in real estate for last 16 years. And whatever I learned and whatever I saw and whatever I believe, I think I will share with you. And I will provide you the data, and it's up to you to choose investment or talk to your tax advisor, your attorney, and other experts in this field and make the final decision. So one thing I tell everyone is learn about real estate. That is the key. Repeat after me, you too. Real estate provides the highest returns, the greatest value, and the least risk. And Franklin Roosevelt once said, real estate cannot be lost or stolen, nor can it be carried away. Purchase with common sense, paid for in full, and managed with reasonable care. It is about the safest investment in the world. So, is it time or is it safe to invest right now? So, that is the common question. The answer is, since 2013, real estate has ranked as the top investment pick for the majority, 35% Americans, according to Gallup's annual economy and personal finance survey conducted in early April 2020. That puts real estate ahead of stocks and mutual funds, 21%, saving accounts, 17%, gold, 16%, and bonds, 8%, as the most favored investment is the real estate investment. It may be the top investment pick, but is it investing safe in it? Just like any other investment, real estate investing has risks. Real estate investing can be lucrative, but it's important to understand the risk. Risks include bad locations, negative cash flow, high vacancies, and problem tenants. Other risk includes the lack of liquidity, hidden structural problems, and the unpredictable nature of the real estate market. Sometimes real estate is not set it and forget it investment. You should monitor your investments and adjust your entry and exit strategy as needed. Choosing bad location. Someone asked a think tank of real estate that what should I look when I go to find a good piece of real estate for investment? And he said that you should look three things. And number one thing is location. And said, what's the second one? He said, location. He said, what's the third one? He said, location. So location is very, very important. Location should always be your first consideration when buying an investment property. After all, you can't move a house to a more desirable neighborhood. Once you bought it, it's there. You cannot move around. Nor can you move a retail building out of a neighborhood, abandoned strip mall. Location ultimately drives the factor that determines your ability to make a profit. The demand for rental properties, type of properties that are in the highest demand, tenant pool, rental rates, and the potential for the appreciation. In general, the best location is the one that will generate the highest return on your investment. You have to do some research to find out where that is. The other thing is negative cash flow. Cash flow on a real estate investment is the money that's left after paying all expenses, taxes, mortgage payments. Negative cash flow happens when the money coming in is less than the money going out, meaning you lose money and receive low return on your investment. So you are thinking, then what's the reason why negative cash flow happens? So there are reasons. High vacancy, mean that your property is not getting tenants, too much maintenance, high financing costs, not charging enough rent, not using the best rental strategy, for example, focusing on long-term renters when the area is prime for Airbnb, at least before the pandemic stopped most travel. The best way to reduce the risk of negative cash flow is to do your homework before you buy. Take the time to accurately and realistically calculate your anticipated income and expenses. And do your due diligence to make sure the property is in good location. High vacancy rates. Whether you own a single family house or an office building, you need to fill those units with tenants to generate rental income. Unfortunately, there is always the risk of high vacancy in real estate investing, which means you could end up with negative cash flow. High vacancies are especially risky if you count on rental income to pay for the property's mortgage, insurance, property taxes, maintenance, and other things. The primary way to avoid the risk of high vacancy is to buy an investment property with high demand in, you guessed it, a good location. So location. You can also lower your vacancy rate if you price your rental rates within the market range for the area, advertise, market, and promote your property, being mindful of where your target tenants might look for property information. Traditional methods are online. There are magazines, newspaper, Craigslist, a lot of things. So you can use those and then start looking for new tenant as soon as current one gives you notice they are moving out. Make sure your property is clean, tidy, and well maintained. Offer incentives and rewards to keep tenants happy. If the tenants are happy, they will keep your property nice, cared, well maintained. If they are not happy, they will destroy it or they will leave it. So list your property with real estate professional. Develop a reputation for being nice and renting quality properties. Think about Airbnb reviews, like what the people say. So you make your strategy accordingly. Problem tenants, another issue. To avoid vacancy risk, you want to keep your investment properties filled with tenants. But that can create another risk, problem tenants. A bad tenant can end up being more of a financial drain and a headache than having no tenant at all. Common problems with tenants include those who don't pay on time or don't pay at all, which could lead to a lengthy, costly eviction process, going in court and fighting the case for 2-3 years. So they end up trash the property. Don't report maintenance issue until it's too late. Host extra roommates. Humans are the very kind ones. So ignore their tenant responsibilities. Those are the issue goes with the tenants. So while it's impossible to eliminate the risk of having a problem tenant, you can protect yourself by implementing a thorough tenant screening process. Be sure to run a credit check and criminal background check on every applicant. Also, contact each applicant's previous landlords to look for red flags like late payments, property damage, and of course, eviction. If they are evicted from the previous property, you don't need them. They will be causing problem. So be sure you and your investment properties are adequately insured against losses and liabilities. It's also recommended that you investigate a potential tenant work history. Hidden structure problem, that's another issue. That you should know before you buy the property. One sure way to lose money on an investment is to underestimate the cost of repairs and maintenance. For a typical single-family home, for example, you could be looking at as much as $12,000 to repair a foundation, or $16,000 to fix the siding. So if you are not looking around your building, the flow of the water or water seeping into the foundation, then it will end up paying $12,000. If you are not looking around the building for wood rot, it will grow and you will end up replacing all the siding, which will cost you around $16,000 or more. It depends on the size of the property. Thankfully, you can lower this risk if you thoroughly inspect the property before you buy it. Don't skimp on hiring a qualified and reputable property inspector, contractor, mold inspector, and pest control specialist to look under the hood and uncover any hidden problems before they become your problem. If a problem is discovered, find out how much it will cost to fix and either work the cost into your deal or walk away from there. So, and other thing, lack of liquidity. If you own stocks, it's easy to sell them if you need money or just want to cash out. That's not really the case with the real estate investment because of the lack of liquidity. You could end up selling below market or at loss if you need to unload property quickly. While there is not much that you can do to lower the risk, there are ways to tap into your property's equity. If you need cash, there are some ways. For example, you can take out home equity loan for residential rental properties, do a cash out refinance, or for commercial properties, take out commercial equity loan, or equity line of credit. So there are many ways to come up with the money. The bottom line, the real estate has traditionally been considered a sound investment, and savvy investor can enjoy passive income, excellent returns, tax advantages, diversification, and the opportunity to build wealth. 90% of the wealthiest millionaire in the world, they became from real estate. One big example is our president, Donald Trump. What's his business? Real estate. So it's not bad business, but you have to do your due diligence. So come back to the risk. You can limit those risks through conducting due diligence, real estate market analysis, and rental property analysis. Also be sure to hire pros to inspect the property, screen potential tenants, and learn everything you can about the real estate market. That's another key. Learn about real estate market, so that will help you to make good decisions. So the benefits of investing in real estate are numerous. With well-chosen asset, investor can enjoy predictable cash flow, excellent returns, tax advantages, and diversification. And it's possible to leverage real estate to build wealth. Thinking about investing in real estate, here is about you need to know about real estate benefits and why real estate is considered a good investment. So let's talk about that. Real estate investor make money through rental income, appreciation, and profit generated by business activities that depend on the property. The benefits of investing in real estate include passive income, stable cash flow, tax advantage, stable cash flow and tax advantages, diversification, and leverage. In general, you can deduct the reasonable cost of owning, operating, and managing a property. You can depreciate the cost of building, but not the land. Remember this. You can depreciate the cost of building, but not the land. Land never depreciates. It's always appreciate. So that's the golden rule. And since the cost of buying and improving an investment property can be depreciated over its useful life, so 27 and a half years for residential properties and 39 years for commercial, you benefit from decades of deductions that help lower your taxed income. Another tax perk, you may be able to defer capital gains by using 1031 exchange. A lot of people know 1031 exchange, but if you don't know about the 1031 exchange, you can call me and I can explain and help you on that too. And if you don't know about 1031 exchange and you are selling a property and you took the money and then you are going to invest, you will pay a huge amount of taxes. So, appreciation. Real estate investors make money through rental income. Any profit generated by property-dependent business activities and appreciation, real estate values tend to increase over time. And with a good investment, you can turn a profit when it's time to sell. Rents also tend to rise over time, which can lead to higher cash flow. So here is the chart from the Federal Reserve Bank of St. Louis, average from price in the US since 1963. The areas shaded in the gray indicate the US recessions. So look at this chart and you will know that the prices are going up. An asset that part of your net worth. And as you build equity, you have the leverage to buy more properties because you have cash in that building, and that you can put collateral to the bank, and bank is easy to finance more and increase cash flow and wealth even more. Portfolio diversification. Another benefit of investing in real estate is its diversification potential. Real estate has a low and in some cases negative correlation with other major asset classes. This means that the addition of the real estate to the portfolio of diversified assets can lower portfolio volatility and provides a higher return per unit of risk. So what's the leverage, real estate leverage in that? Leverage is the use of various financial instruments or borrowed capital like debt to increase an investment's potential return. A 20% down payment on a mortgage, for example, gets you 100% of the house you want to buy. That's leverage because real estate is tangible asset and one that can serve as collateral. Financing is readily available for those. Another thing is competitive risk adjustment returns. Real estate returns vary depending on factors such as location. You remember I talked to you about location? Yes, location will come again and again because that's the key for the real estate investment. So, such as location, asset class, and management. Still, a number that many investors aim for is to beat the average return of the S&P 500. What many people refer to when they say the market, quote unquote, the market, the average annual return over the past 50 years is about 11% in the real estate. So it's higher than any other thing. So inflation hedge, another benefit of it is inflation hedge. The inflation hedging capability of real estate stems from the positive relationship between GDP growth and the demand for real estate. As economies expand, the demand of real estate drives rents higher. This, in return, translates into higher capital values. Therefore, real estate tends to maintain the buying power of capital by passing some of the inflationary pressure to tenants and by incorporating some of the inflationary pressure in the form of capital appreciation. The bottom line, what is the bottom line? Despite all the benefits of investing in real estate, there are drawbacks. One of the main one is the lack of liquidity, or the relatively difficult in converting an asset into cash and cash into asset. Unlike a stock or bond transaction, which can be completed in seconds, because it happens in computer. A real estate transaction can take months to close. Even with the help of a broker, it can take a few weeks of work just to find the right counterparty. So still, real estate is a distinct asset class that's a simple to understand and can enhance the risk and return profile of an investor portfolio. On its own, real estate offers cash flow, tax breaks, equity building, competitive risk adjustment returns, and hedge against inflation. Real estate can also enhance a portfolio by lowering volatility through diversification, whether you invest in physical property or real estate investment trusts. So now, if you are still thinking to buy real estate, so I will give you some tips of buying your first rental property and what features you should look on those, and how to calculate the real estate return on investment and return on cash, different calculations. And at the end, I will let you know about buying rental property or flipping houses, which one is the good. But today, I think that's enough feed so you can process and understand. So watch it a couple of times and then you will understand. And if you have any question, you can call me always. My number is there, and I'm not far away, so I can help you anytime you need. But best thing is to learn about real estate. Real estate, location, location, location. Next time.